You're listening to The Wealth Advocates with John Mickelson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Welcome, Wealth Advocates Nation. It's great to have you back this morning. We're in an exciting period of life. We're going to talk a little bit today about weathering volatility. We're lucky to have Scott Grover with us. Scott, thanks for joining us. And the man, the myth, the legend, John Mickelson, giving us his insight on what's going on in the market. So guys, let's talk a little bit about weathering volatility, but maybe we had a frame where this is going to fit. We're going to talk a little bit about long-term horizons, well, really what your horizon needs to be. And then Scott, you're going to educate us a little bit on the psychology of investing, right?
Correct. Yep.
And where this all fits in, Wealth Advocates, we specialize in this general concept of getting your investment plan to match your tax plan, to match your estate plan, your income plan, and your risk mitigation plan. So those 5 core elements, it's not just about getting your investing right, because if all those other elements fall apart, your entire plan. So coordinating that estate, that's what we're really about. Today we're going to talk about 2 of those 5. We're going to talk about your investing plan and your risk mitigation plan. John, we'll kind of launch with you. We're right in the middle of just some market anomalies. It was an awful year last year. It's been a pretty good year this year. I've got a lot of clients calling me saying, what's going to happen next? Now, we're recording this right in the middle of Q2 reporting. So far, 99% of the S&P 500 has reported. 79% of those, this is the emotional side of it, 79% have reported better than expected earnings per share. 64% have reported surprise earnings beat. So everybody's waiting for the other shoe to fall. What's going to happen here, John?
Yeah, and I think that illustrates exactly the human emotion side of things. Mm-hmm. If you look at that statistic right there versus what was the perception and the feeling prior to those numbers coming out, it was all negative. It was all, recession was starting to taper down a little bit as a discussion, but it was still there. Oh, things are going to get bad. Well, what happens is human emotion kind of kicks in and you see things swing up or swing down, and then the real numbers come out and everything equilibrates back to where it's supposed to be. So you have this interim where you cannot trust what is happening because people's human behavior takes over.
True.
And then the real numbers come in, and then you see where the reality
is. And
I've
got people calling me and they've seen this big rush up since summer.
Yeah.
Peaks in August, slowly trickles down. That's very seasonal. And they say, hey, maybe we better get out.
Yeah.
What do you say to that?
And part of that is also going back to, if you look at charts. Now charts, I can cut and paste those things to say anything I want, negative or positive. But you look at the last year, like last year was the effect of inflation and too much money in the system. And so we see this terrible year where companies were like, oh my gosh, my costs are doubling, both lending, my expenses on materials. And so they're concerned about losing money because their costs are way high and they can't charge more. Then they retool and they reprice. And then they reprice not only the materials, but also their profit margins. So if you look historically, inflation has not been a bad thing for stocks.
Classic example is Apple. They're in the 3rd year of releasing the iPhone 13.
Yeah.
It's the same stupid phone. 3 years in a row with a different power port, but they're charging more money for it.
Yeah, almost
so their
8% more. They're raising price by 8%.
Yep.
Which is pretty high.
It is.
Especially for a smartphone that's now, $1,200 or $1,300 for the base of the phone.
Right.
Anyway, but it is case in point where we can say, we're starting to see the profits come in, and they are good. And so I think that the perception and the reality are kind of far apart. Let me back up one step. Even when you talked about the different pieces that we have to coordinate within a financial plan, that's different than what we do in terms of timing what we do on investing. Mm-hmm. Someone that's in the early growth stage, they're not worried so much about the estate planning side. They're worried about debt management and getting started. That's a very different discussion. When we talk about, the now, soon, and later money. Now money, that's the money you have sitting in your bank account that you need at the drop of a hat. I can walk in today and get it. The soon money is going to be things, and that's where the early growth stage comes in. I talked to a family member yesterday about her college needs. a new home. I mean, she's looking at the early things, debt management, all that kind of thing. And that's the middle stage, middle bucket. Soon I need that money. And then you have the later. Do I need to be worried about going to have retirement? What's my standard of living going to be? Is it going to be higher? Is it going to be lower? Is it going to be about the same? I mean, that's where we come in and say, let's project that out and create something where we can see, okay, a year from now, we're going to take the exact same projection. Was it better than we thought or worse than we thought? Are we on track? And it helps us make decisions on, if I know my long term's on track, it helps me say I can afford to do other things. So that's, I think, a really critical point in this whole idea of where are we with the market? When we get back to what we were discussing with Apple and everything else, if we have our defense in place, we can play against that and say, look at what's happening. Where are the opportunities? And they are everywhere right now. And the perception is they're not opportunities. There are. Yeah. It's amazing what's happening.
Tremendous opportunities. Let's collectively talk about market timing. Yeah. I am a big fan of telling all my clients I am awful at market timing.
And so are they.
Awful. They're worse. They're worse. Market timing is something everybody thinks they can pull off. They see the cycles. I even said just a minute ago, this is the cyclical element of the market, where it sloughs off from August, it picks back up in October, ends in a flourish by December. Is that real?
I mean, there's we've all heard of FOMO, fear of missing out.
Yep.
And we all have that buddy that loves to tell everybody about how well they did, how they picked Bitcoin before it went up, how they picked Tesla before it went up, and they got out before it went down. However, I know for a fact that no one brags about what they lost. And what happens is we hear those stories, and we don't want to miss out on that. I mean, you can get really rich really quick in this type of a market. But by the time you hear about it, we all know it's probably too late.
Yeah. So do we get in? Do we get out? Do we, hedge things, or do we stay in for the long haul? How do you advise your clients on what to do in a volatile market?
Well, I think the biggest thing is define who they are as an investor. Everybody knows. Okay, so if I put my defense in place first, if things get bad, I know where I'll turn for money in the downturn, and I know the downturn won't last forever. It'll last for a year or two. We've only had 2 periods in history where it's been negative for 3 years in a row. 2000, 2001, 2002, and the Great Depression. So only one during our lifetimes. So it doesn't stay down forever. The key is, do I have enough defense in place? If I have the defense in place, then we can start defining who am I as an investor. And what that means is risk to me may not be the perception of the risk to the person sitting in front of me. And so deciding what that means is understanding in the ups and the downs, how far down do I feel comfortable going and how far up? I know logically, the more risk I take, the more return I'm going to get with the swings up and down. It's a fact. I mean, it's repeated. Right. But it doesn't mean that when I hit that low point on the cycle, that I'm going to feel like, okay, I'm okay. People get anxious. I mean, and I do too. Everyone does. The key is, can I stomach, on a scale of 1 to 10, if I'm a 6, am I okay on the downside? If I'm a 10, am I okay on the downside? Okay, everybody's going to be different. How will you behave when that happens? Because I've had people pull out in the downturn, and a lot of times I see them pull out at the right time. The big mistake I see is they miss the upswing. They miss the best part of the upswing is probably a better way to say it.
So let me color this conversation with this graph that's up in front of us. This is a Bloomberg research study. They said you put $10,000 in the S&P 500 index for 42 years, from 1980 to 2022. And what happened? The $10,000, if you were invested the entire time, turns into $1,060,000. That's a huge, huge return. But what happens if you miss out on the 50 best days? Now, I've got clients that truly believe they can time the market. Let's get out right now. We'll get back in when we see these indicators occur. If you just missed 50 good days in those 42 years, you only lost $75,000. But let's step backwards. Let's say you missed just 30 days in those 42 years. Well, you miss $171,000 of growth. You missed 10 days. You missed out on $472,000 of growth. And here's the kicker. If you, in those 42 years, just missed 5 of the best days there. And when are those 5 days? I have no idea.
And no one else does either.
You missed out on $655,000 $100,000 of growth. That is more than one half of all the growth occurred in 5 days of those 42 years. Yeah. What's the antidote?
I think it goes back to what John was talking about, and that's, when we put together a plan for a client, we designate money for now, for soon, for later. If we have that plan in place before the market has those drops, before it has those big upswings, we have something to point back to when we're feeling those emotions of missing out, or like we should be doing something different. Mm-hmm. And knowing what we're going to do before it happens is a huge benefit to have.
Mm-hmm. Mm-hmm. Yeah, I'd emphasize also that the outside third-party coach is a critical piece in the whole thing, because it forces you out of your emotional state and gets back to logic and probability. And that's where I think we play one of the biggest roles. The other thing I'd emphasize is, besides that coaching role, is knowing when to move or change the portfolio. You don't hold the same things forever. Set it and forget it is a thing of the past. That is a bad situation. And we want to be able to say logically, when do we make adjustments and changes to the portfolio without necessarily getting out and missing out? So I think that's an important piece.
Great segue. Scott, you talked earlier about FOMO, the fear of missing out. Talk to us a little bit more about the psychology of investing. What investors go through, and how do you combat that emotion that might be driving the gravitational pull to move?
Yeah, I mean, especially in today's markets, everything happens so quickly. So there's a lot of knee-jerk reactions that we want to take just so we don't have that FOMO, we don't miss out, and we don't look back and say, oh, I wish I would have done this, I would have bought this or stayed in this. You just can't do that to yourself. And if you have that plan in place beforehand, you know exactly what you're going to do. And it is an emotional roller coaster. And right now we're in the phase of everyone thinks the sky is falling and it's never going to get better. But John mentioned market cycles. The market works in cycles. We're in a down cycle. And with every cycle of the market, there's opportunities. And going back to having a coach and an advisor, is we're here to help you see those opportunities, take advantage of them. You may not see the benefit of them until later down the road, meaning when the market's down and we tell you it's a good time to buy, it's counterintuitive. You don't want to buy. You want to, curl up and just say, sell everything, and then when it gets better, we'll go back in. This graph behind you, it definitely reminds me of something I've seen when building a home. So they talk about the excitement that you get when you first buy the home. And then things start going along. You're like, this isn't what I thought it was going to be like. And it's going slower. They are messing up. And then it gets better. You get back in your house and all is well. So I like how it talks about this, and knowing that those emotions that you're going to feel when the market goes up, when it goes down, those are completely normal emotions to feel. And our job is to be a sounding board for when you're feeling those emotions. We can keep you in check. We can make sure we're making good, sound decisions. We help you protect you from yourself. We all need that in life. And that is probably the most important role we play. We're not trying to time the market. We're not trying to pick the hottest stock. We're gonna make sure you're in sound, good investments. We have a plan in place for you. And if you stick to that, you will be successful.
I love it. We're right in the middle of our end of year planning. We are meeting with all of our clients, getting them ready for end of year. What moves, what changes do you need to make? So this will be core conversation when we bring them in and we talk about what's keeping you up at night, what's going to happen with the market. And I love the house analogy. I often tell my clients, hey, we are farming here. This just takes a while. Put a seed in the ground, let the thing take off. John, talk to us about staying the course, being disciplined about investing.
Yeah, I think the biggest thing is to say, has my plan changed? And it will. And that's the other. I think people think, okay, I'll just set a plan and it just stays. You're going to change your priorities. You're going to finish on certain objectives and goals, and you're going to have to adapt and change, especially as you look at like family relationships, higher net worth. Those things are very changeable. And especially between now and the end of the year, one of the advantages we have over our partners that are accountants is we are anticipating what needs to be done before the end of the year. The accountants really don't do that. They do that, well, they do, but their major objective is they're busy enough that they're looking at it after it's done. So they a lot of times can't do anything about the things that need to be done before. That's where we come in, is to try to say between now and the end of the year, let's make sure that we're seeing every aspect of that tax return Are we hitting all the things that need to be done before the end of the year for all those deadlines? That's what I'm worried about between now and the end of the year. Do we have the right things in place? And again, it goes back to those 5 objectives, not just for your investments, but for your estate plan and everything else that's correlated into it, income and everything else.
Excellent. Scott, any final takeaways?
If you don't have a plan in place, you can plan to fail. Or something to that effect, right?
Yeah, I love it. Well, if you have enjoyed this, we're looking forward to visit with you for your end of year planning. And if you know somebody that's outlived their do-it-yourself model, please let us know. Don't keep this a secret. It's a pleasure working with you. Goodbye, Wealth Advocates Nation, and good luck.
Thank you for listening to the Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts.